So we're going to take a slightly different route with our next presentation. Our next speaker is Paul Nixon, Head of Behavioural Finance at Momentum. Human behaviour impacts every aspect of our lives, but probably no more less important than in financial decisions. Therefore, it's really pivotal that advisors, first of all, understand clients' emotions when making financial decisions, but also are then able to adapt how they approach particular clients. And we'll have all seen that, certainly in COVID, certainly in the recent financial crises that we're seeing. So, here to tell us more, ladies and gents, Paul Nixon.
Just walking around here during lunchtime as well, the amount of times that I hear during lockdown and COVID, COVID is still very much a part of our lives, right? And we've all got COVID stories to tell. I think even though we're looking at COVID now through the rearview mirror, I think we're all happy, or at least happier, to be getting alcohol these days in the right end, right, which is in our mouths as opposed to kind of, mostly on our hands, right? But I think, because we've all got COVID stories, I thought I would start today's session with one of my own COVID stories. So my wife and I are certified coffee snobs, right? So hands up, coffee snobs out there, right? I see a few. Hey, there we go. Phil, Steve, I'm sure you are one as well. Has anyone been to a coffee tasting before? Like, not a wine tasting, a coffee tasting. Okay, so here we go. So if you see someone aggressively slurping coffee with a spoon, right, you're at a coffee tasting. And the reason why they do that is because, as you're slurping the coffee, you're introducing air right into the liquid, which releases a little bit of the flavor. So the coffee culture in South Africa is evolving. It's catching up with the rest of the world. And in actual fact, anyone heard of geisha coffee? People are willing to pay more and more for coffee, just like they are willing to pay more and more for wine. So geisha coffee, you can expect to pay anywhere between $8 and $80 for a cup of coffee, right? And the reason is that the geisha coffee tree it takes about 8 years to bear its fruit. So coffee lovers would know, the more time it takes to bear fruit, the more flavor gets sucked up into that bean, right? So my coffee story is my wife and I decided to open a specialty coffee store in Benoni on the East Rand of Johannesburg. And we did so about 3 weeks before national lockdown. Right? Of course, we didn't make the decision to do it then. Of course, we'd signed the lease 6 months before. But we ended up being in hospitality in the middle of national lockdown. Right now, I can tell you for free what that feels like. It feels like you're on the Titanic. So remember the movie? Remember when the ship is sinking and the band just decides to take out the instruments and carry on playing? We were the band. There is nothing you can do but you watch your world unfold around you. Now, I'm going to circle back to this at the end, but in essence, there's 3 key messages that I want to get across today. And the first one is emotional biases cause a behavior tax, right? It doesn't matter if you're in the coffee business, if you're trading stocks, or if you're giving investment advice. The second one is that investment advice is much more than just about numbers, right? It's an excellent opportunity to engage people, connect with people, and help them process their financial struggles that they're having, which is worth something. And the last thing is that perspective matters, right? Perspective matters, and it matters a lot. And that's where I'm going to start off on today's presentation, because perspective is very key to understanding the disposition effect. Okay, so nice way to show this. If we're going to understand the disposition effect, we need to understand something about context. Okay, so Dogbert consultants have a wonderful way of looking at this. Very cynical, of course, but that's what makes it fun. So in the left there, Dogbert is basically saying to the manager, your fake 50% sales price makes dumb customers feel like smart shoppers. Now, the reason for this is that marketers and retailers have known for a very, very long time that they need to get us from the spend frame to the save frame, right? We don't like parting with our money, right? We're naturally loss averse. But by buying something 2 for 1 or 50% off, we're actually saving money, right? Because now we're getting 100% off, right? So if we feel better about something, in other words, when we go to the save frame, we feel better about it and we feel smart about it as well, right? Because we found something. And that's what economists will call a transaction utility. Now, in the middle frame, the manager is saying, well, why am I paying you $400 an hour to tell me what I already know? And of course, Dogbert finishes off this conversation by saying, well, usually I charge $800 per hour, right? And of course, the manager leaves that engagement, yes, I'm a freaking genius, right? So feeling very, very smart. And of course, you know, the manager has fallen prey to the very same tactics that he uses on his customers. Now, if you doubt the power of this, I'd like to take you back to 2011. So JCPenney, largest discount retailer in the US. Everyone's heard of JCPenney, right? And JCPenney decided to headhunt a chap by the name of Ron Johnson from Apple. Now, Ron Johnson's claim to fame was he rolled out about 400 of their Apple Experience stores in the US. And one of the first things that Ron Johnson did was his first strategic decision was to change their pricing policy, right? So in a very famous media interview, he got up and he said that people will come to our stores because they're great places to hang out, right? That sounds very Apple. I'm not sure if that sounds JCPenney, but they'll come to our stores because they're great places to hang out and people would be happy to pay an everyday low price for everything. So what happened in this situation is, what happens when you take away the transaction utility that people get when they find stuff that's good value or cheap? They just go somewhere else, right? And that goes down, you'll see it in the MBA case studies, is like one of the most epic strategic fails by a company or by a CEO, costing JCPenney billions of dollars, right? So don't underestimate the power of what's demonstrated very clearly in this Dogbert cartoon, right? So perspective definitely matters. All right, so let's get a bit more practical. Let's see how retailers use this. So what you can see on the screens now are two deals for a cup of coffee, right? Still on the coffee theme. One of them clearly sucks, okay? And it shouldn't take you very long to figure out that it's the one on the right. Okay, so the one on the right looks like a bad deal. $2 versus $8. The question is, how do we get people to buy the bad deal? And the way we do that is we add in another option, right? So we add in an option in the middle. And what we do by doing this is we change the perception of what the bad deal is, right? So the option in the middle now is $7, and all of a sudden the deal on the right looks like the good one. Right, so again, this is about changing perspective, changing perception. And what obviously is happening here is our attention is drawn to the middle and to the right option. Okay, and this is a tactic that's very, very famous and well utilized and is called the Decoy Effect. Okay? But I mean, that's a cartoon. Let's have a look at something. We talked about Apple. Let's have a look at something from Apple's website. So here are actual deals for Apple MacBook Pros. And let's quickly just work through them. I'm not sure if you can see that right at the back. So right at the left, we'll see that there is a deal for a 2 gigahertz processor, 256 gigabytes of storage for $1,499. Okay. By the way, some nice psychological pricing there because we know that $1,499 is way less than $1,500, right? In the middle, we go to a new feature, right? So now we've got the Touch Bar and Touch ID, a 2.9 gigahertz processor, and 256 gigabytes of storage once again. Okay, $1,799. And on the far right, Touch Bar and Touch ID again, 2.9 gigahertz processor again, 512 gigabytes of storage, okay, for $1,999. So who's going to be brave and shout out, which one is the decoy? The middle one. Lady in the front, I heard that there, right? So the middle one is obviously the decoy, right? So if we take it out, we can see that if we don't have the middle one, these are kind of difficult to compare. So whatever you buy is probably going to depend on your preferences, right? You either need a faster processor or you want like storage for your photos and your song, and music. But the moment we add the middle option in, our attention is drawn to those two simply because they're quite similar. They've both got Touch Bar, Touch ID, both got 2.9 gigahertz processor, but now we're getting double the amount of storage for $200. Okay, so we're drawn to the right option. The middle option is the decoy, right? And by the way, when you finish this stuff as well, they've measured people under fMRIs. You feel very smart when you pick the right one. like very smart. Huh? So there's like parts of your brain that lights up. Again, it's transaction utility. So you feel good about the system because you figured it out, right? But of course, that's not really the way things work. So marketers have known that in order to get you to buy stuff, they can work and fiddle with the way you perceive stuff. Okay, so let's make this a little bit more, let's head towards the world of investments. What you can see on your screens now are two states of mind. Okay, winning, losing, gains, losses, green and red. And you'll see that those two states of mind are separated by a blue dot in the middle. Right now, from a stock trading perspective, that is the price that you paid for the stock. Now, what happens when the price goes up? You move into the green zone or the win zone, right? When the price goes down, you move into the loss zone or the red zone. You'll notice that the red block is bigger than the green block, about 2.5 times bigger, because you will experience about 2.5 times the dissatisfaction when the price goes down by £100 than you will satisfaction when the price goes up. You don't feel the same way. It creates two separate states or two sets of emotional biases, right? In the green zone, we become regret averse, right? So we're worried or we fear that the position is going to reverse, right? So the winning position is going to turn into a losing one. In the red zone, we become loss averse, right? So because losses are so painful, we don't want to hit the trigger or pull the trigger on the trade so that we actually realize that loss. So these two different states of mind create a behavior tax, right? We end up not trading enough in the green zone. Okay, so we actually miss out on the gains, and we end up not trading enough in the red zone. We let the losses run, and we end up trading too much in the green zone, right? Which means we miss out on future gains. And the combination of these two things is called the disposition effect, right? Two emotional biases. In global literature, about 1.3 to 1.4 times, right? Which means that there's 1.4 trades in the green zone for every trade in the red zone in general. Now, for the technically minded of you out there, if you don't worry too much about the lines in those two diagrams just indicate a change in preferences. Okay, in the red zone, the line is steep, which just indicates a loss aversion, right? So way more sensitivity to losses, which means that, again, we're not pulling the trigger in the loss zone. So let's quickly just go through how we calculate the disposition effect, right? What we're pretty much doing is looking at the probability distribution on either side of that blue dot, right? So we're checking to see how likely people are to trade on either side. So let's assume we have MMH shares, and MMH shares start off at $15 in January, and a trader buys 100 of them. In March, share price drops a little bit to $13 a share, a trader buys another 100. In April, the price is now 16 Rand a share. Trader decides to get out of the position or sell out of the position. Now, the minute there's a trade on the Momentum Securities platform, that pretty much goes under the microscope, right? So we have a look at what the trader sold versus what they could have sold. And in this example, we see that the trader was also holding ABSA shares. And for the ABSA shares, we see that the average buy price was 160 Rand, current share price is 150 Rand. In other words, that position is in a paper loss position, right? Now, in this example, the trader converted 100% of their paper gains into real gains with MMH and converted 0% of their paper losses into real losses. Green zone, red zone, right? And that indicates to us basically that there's a disposition effect at play because the trader is more likely to trade in the green zone than the red zone. So that's just quickly how we calculate it. If we move over to the results, so we can see that a large study we conducted on the Momentum Securities platform, 10,000 clients, about 9 billion Rand in trades, 2016 to 2021. The overall disposition effect on the platform is very similar to international standards, 1.39 times. Surprise, surprise, in COVID, there's a mountain. Right, so COVID kind of just amplifies our emotional biases once again. So what's happening in COVID? The disposition effect increases to 1.9 times. Okay, now I'm just going to go over briefly again what this means. So remember, green and red zone. If it's 1.39 or 1.4, there are 1.4 trades in the green zone for every trade in the red zone. That means 1.4 out of 2.4 trades, or 58% of trades are happening green zone, right? When it escalates during COVID, 1.9 trades for every one trade in the red zone. That means 1.9 out of 2.9 trades in the red zone. That is 66%, right? And of course, the reverse means that only 34% of trades are happening in the red zone. Okay. So remember, the culmination of this, the behavior tax here, is that we are not trading. We're not trading enough in the green. We're not trading enough rather in the losing zone, and we're trading too much in the winning zone, right? So we're missing out on gains, and we're also letting our losses run too much. And that really is the kind of major effect of the behavior tax here. Now, this gets very interesting when we start contrasting this with behavior in unit trusts on the Momentum Wealth platform in unit trusts, right? So if we look at exactly the same time period, so 2016 to 2021, okay, we see the mountain again there, right, during COVID. So this is investor behavior on the Momentum Wealth platform. And obviously there's no trading happening here, but people are still engaging with their portfolios by switching, right? So what we can see here is that in 2020, every switch transaction on the Momentum Wealth platform on average wiped out 6.5% of that client's portfolio value, okay? 6.5% per switch on average. In 2021, that subsided a little bit to 3.5%. I can tell you that those levels are well above what happened in GFC or global financial crisis in 2008. And what we can also see, that line is on the way up again. So, again, with the introduction of the war in Ukraine, higher inflation prices, the behavior tax has elevated once again with market volatility. But I think what's important here, if we contrast this to the disposition effect study, is that engagement in portfolios in unit trusts was up by 50% during COVID, right? That's record levels. Engagement in retirement income option or living annuities was up by 100% during COVID, right? So that's in retirement savings now in living annuities. So just think about this for a second. We've got two groups of people, right? We have execution-only traders who are becoming extremely loss-averse during COVID, right? So the disposition effect is basically telling you people are loss-averse, right? They're very scared to trade in that red zone. So we have execution-only traders who are taking their hands off the steering wheel during COVID. And we have advisors who are advising clients in unit trusts and living annuities who are increasing their engagement during COVID, right? So one group is taking their hands off the steering wheel, the other group is actually becoming more engaged. And I think there's some very interesting differences between those two groups of people, particularly when we look at the context of the decision. But it certainly appears that the behavior tax is directly related to the advisor's disposition as well. And I think that's something that we can debate at the end as well. But this is very, very interesting in terms of just the surface level results. So the question now is, what do we do with all this stuff? So I've showed you two pieces of research. How can we help advisors and clients to make better decisions? And the answer really lies in segmentation, right? So I'm going to unpack the securities results a little bit more because they're very interesting. Things get even more interesting when you start slicing and dicing the data. So what you can see now on your screens is different groups of people on the horizontal axis by age. And what you can see on the vertical axis is the first row is going to tell you the proportion of the population that group makes up. The second row is going to tell you the assets under management of that population group. And then right down at the bottom is going to show you the disposition effect during COVID, before COVID and during COVID. Okay? Now, I'm going to draw your attention to the Gen X's, right? So Gen X's make up 28% of the Momentum Securities platform. They also hold about 28% of the assets under management. During COVID, or before COVID, their disposition effect was 1.92 times, so really way elevated above the levels that we'd expect from international norms. During COVID, their disposition effect increased to a whopping 3.92 times, right? And what that basically means is those traders were 80% of their trades, in fact, more than 80% of their trades were taking place in the green zone, less than 20% of their trades were taking place in the red zone, okay? So what do we do with that information? There's plenty of information or plenty of research out there to show that a very, very good way to limit the disposition effect is through stop losses. Now, what happens with a stop loss, if you think about it, you're setting a rule before you get into an emotional state about what your minimum is, right? So at 90%, I'm out, I'm done, that's my rule, right? And once you enforce, or once you put that rule in place, and you actually act on it, because that's an important piece as well, right? You have to pull the trigger. It means that we can actually increase the engagement in the loss zone, research shows, by 100% or more, okay, with a stop loss. But what we also do in the green zone is, by using a stop loss, we buy psychological insurance, right? So even if our position does reverse, we now have a floor on the losses that we can take. And we see that actually trading increases by just under 50% in the green zone when using stop losses as a trading strategy. Right, so these are some of the things that we can do again to communicate through segmentation to start addressing this element, or this idea of a behavior tax. Now, what we can do in the world of unit trusts, or what we have done in the world of unit trusts, there is, we use some machine learning algorithms basically to help us unpack a lot of switching data, right? So from 2006 to 2021, and what we basically do is we train the algorithm to look for similarities in risk and return preferences, right? So the algorithm basically here is going to look at clients who are doing the same stuff at the same time. And we found 4 statistically significant patterns of behavior on the Momentum Wealth platform in unit trusts, okay? And the first one we call the avoider, right? So avoiders are risk averse. They don't like risk. They generally stay away from it. And when they do invest, they tend to get stuck in conservative assets, okay? I think we all have clients like that, right? People who just kind of stay away from risk, and they want to stay in that cash plus space. They have the lowest behavior tax, or lowest value eroded from switching, but they also pay a different kind of behavior tax, right? So we know that staying in safe assets for a long period of time is not a particularly smart investment strategy, okay? Next, we have the market timer. There was a market timer at the back. Next, we have the market timer who's prone to herding, right? So the market timer is greedy when other people are greedy, and fearful when other people are fearful. And you can see there's a very clear pattern of people who do the same stuff as other people do, right? Those are the market timers. They switch to the same things as what other people do. Anxious investors are loss averse, right? There's a very big difference between loss aversion and risk aversion, right? So the anxious investors don't mind taking risk, very happy to take risk. At the first sign of market volatility, though, they move into cash and cash plus strategies, okay? And then finally, we have the assertive investors, the overconfident ones, right? So those are probably your worst, again, your nightmare clients. They're also the least likely to take advice from financial advisors. Also very, very happy to look at the next big investment trend or deal, right? Remember, like cryptocurrency, they say, how do you know someone's invested in cryptocurrency? They tell you. It's like, how do you know if someone studied at Oxford? They tell you. Cryptocurrency, not so much anymore, though. Huh? So what we can see here, and the very interesting thing about this study was that we didn't ask the algorithm to look for behavior tax, but it naturally split the population into different groups that were destroying different value at very different periods of time. Right, so again, it's a segmentation story as well. Can we start engaging with people proactively, giving them the right message at the right time to the right person, right? As we end off this story today, I'm going to sort of circle back to where I started. So about 6 months after we opened our specialty coffee shop, we decided to close the doors, right, in October 2020. Now, I can tell you as a behavioral scientist, I am not immune to emotional biases, right? So my wife and I battled with loss aversion, right? I mean, we poured a substantial amount of our savings into this venture, right? We battled with regret aversion. So what happens if we close the doors and someone else goes and opens a spot in the same place and they make a massive success out of it? So these are the kind of things that we battled with. We battled with the sunk cost effect, right? When your decisions about the future start becoming more about the past. And by the way, this works in relationships as well, right? If you speak to a psychologist, as well about relationship advice, the sunk cost effect affects us in relationships as well. When you start thinking more about the time you've invested as opposed to the future prospects, you have a problem. So it's very difficult. Having knowledge of this kind of stuff does not make anyone immune to it, right? Because when you get tired or sucked up into that situation, it makes life very difficult. So my father-in-law was a professor of neurolinguistics at UNISA for 20 years. Neurolinguistics is a fascinating field. It's like the science of search engines, right? So when Google says, "Did you mean?" there's a lot of science that goes kind of into the back end of that. And he also studied psychology. And he helped us process the failure correctly. Okay, when I say process the failure correctly, it's important that failure is a bad teacher, or can be a bad teacher, because it hides risk. Okay? So there's stuff that we can control, and that's the stuff we can learn from, right? So the mistakes that we could control, or we were in control of, is the stuff we learn from, but we also need to put stuff at the door, right? Cannot predict, could not have predicted a global pandemic, right? That's kind of stuff you have to leave at the door. We can't take responsibility for that. So he really helped us process this failure correctly, and that, I can tell you, is worth something, because the loss aversion, I mean, we nearly made a decision to open up another shop to try and make up for the one we had, to change the line of business into a full-blown restaurant so we could take advantage of deliveries. Who could we borrow from? Those discussions saved us hundreds of thousands of rand, right? So that is worth something. So I want to go back to the 3 key lessons. Emotional biases can cause a behavior tax, right? And financial services providers have a duty, I think, and a responsibility in the future to help financial advisors diagnose this kind of stuff correctly, right? The second thing is, the second sort of point that, well, the second lesson that we talked about was investment advice is about way more than just numbers, right? So on your tables, I see a few of those infographics floating around. Advisors are starting to collect new skills, counseling, right? Financial therapy, psychology. Psychology is now 8% of the CFP syllabus, right? And the reason is that there can be so much value added in helping people process their financial struggles. And the last thing is that perspective matters, right? So I'll never forget something my father-in-law said to me. So what we did was we took all the equipment that we had and we made a little coffee bar at home. Right, so I've got a lovely espresso machine sitting on the bar with a lovely grinder, and there's really, really nice cappuccinos every morning in the house, right? And he said to me, he came up to me one day and he's like, "Paul, you know, you always buy like 2-3 cups of coffee a day, right?" And I was like, "Yeah." And he's like, "Well, the first cup of coffee you made cost you 700,000 bucks. Yeah." And I was like, that makes me feel great. Thanks very much. And he's like, but hang on a second. The second cup of coffee will cost you 350,000. And the third one will cost you 233,333 rand, right? So eventually, this whole process will have cost you nothing, and all you'll be left with are the experiences. So again, perspective matters. Thank you very much for your time.